Did the Fed just blink? Did the Fed just blink? Is Jay Powell saying uncle? Or is it the markets and economics reality versus the politicians? I don't know. We had, but more importantly, is it too late to sell or should you be buying? Right? Is this a bottom or are we even close? Should you start to be nibbling? How should you handle this volatility? This is a very, very choppy market in a bear market. And are we at the bottom? Well, we're going to talk about that. And we're going to talk about Mike's revisit to one of his favorite sectors. And Ted is going to present his stage analysis that he studied from Stan Weinstein just recently. Now, I had a bunch of topics and articles about the show getting ready to go, from the tax bracket inflation, which is sort of good news for us. They raised the tax bracket levels to compensate for inflation. Of course, it's for 2023, not 2022, which they could have done retroactively. I've seen tax increases retroactively in the past before, but normally you never see tax breaks. It's kind of pathetic. Also, why BlackRock's cookie cutter approach should be tossed out. And by the way, there's lots of class action lawsuits against some of their funds, their target date funds for these big corporations, their 401ks. And related to that is Fidelity. Fidelity wants to seal your IRA rollover. Don't let them, folks. They want to keep the money with them. It's like the Hotel California, you can never leave. And we'll talk about that later. And then the big article I was going to talk about is the point of no return in Chinese real estate. Okay, we've talked about that before, but it looks like it's getting worse. And speaking of real estate or actually shorting real estate, we'll ask Don how my short real estate is doing a little bit later. So I was going to talk about all those things, and if you want to, and if we have time by the end of the show, we're gonna hit those. And if you want any specific advice about any of that stuff, you can certainly reach out to me. But the Fed had to steal the center stage today. They came out this morning and said, maybe we're going to change course just a little bit, or at least we're going to jawbone about it. So we're going to talk about that. But first, we got to give the disclaimer, folks. This show, Your Money Podcast, is not meant to be specific individual investment advice. If you want specific individual investment advice, reach out to me at revereasset.com. You can call me at 855-REAL-WEALTH or Dan at revereasset.com, or pretty much anybody on the Revere team. Or you can reach out to your own advisor. But this show is meant to be for research and educational purposes only. And occasionally you get some entertainment value out of it. So anyway, all right, with the disclaimer out of the way. Now, so the Fed actually decided that, let's see, where does it say? So remember how they were talking so bearish and they were going to do these 3/4 point raises in infinitum into the future, and they could see no end, and the market really was selling off. And quite frankly, the bonds were getting hammered. Early in my career, a professional money manager up in New York told me once, he said, I can't remember his name now, he said, man, pardon my French, all the Fed gives about is the bond market. That's all they care, because that's where they get their finance. They buy and sell treasury bonds, right? So because they don't care about the stock market, all they care about is the bond market. So bonds have been getting killed, and bonds are actually down as much or more than a lot of stocks. I mean, they're down like 25, 30%, right?
Wow. Yeah.
Right? And bonds are supposed to be safe? Not so much. Not right now. Anyway, so, and that's why I say, is it markets and economics, or is it because the midterms are coming next month? And so they're just talking about it. But here's what was leaked by the Wall Street Journal. Apparently they got a report, or they got a source, and they said the Fed is going to raise in November by 75 basis points, 0.75%, which we already kind of knew, and then debate about smaller rate hikes in the future, including a smaller increase in December. Oh, that just set the market. The markets were kind of down before the open. The futures were down a couple hundred points on the Dow, in the red. Pretty good. Don will talk about the specifics, but about 0.75% or something like that, maybe a percent. And all of a sudden, that story came out, and the markets reversed immediately. And now they're off to the races. The question is this just a dead cat bounce, a little band-aid, or is this actually a bottom? And this could be a good buying point. But here's the thing. So they've been 100%, both the doves and the hawks, right, on the Fed have all been, yes, we got to kill inflation, unanimous vote, 100% keep raising. Well, now they said, and I quote, we will have a very thoughtful discussion about the pace of tightening. And many members expressed a, quote, desire to slow down the pace and stop raising early next year to see how their moves this year are slowing down the economy. We want to reduce the risk of an, this is their words, unnecessarily sharp slowdown. Now, others said it would be, quote, too soon for those discussions because high inflation has been proven to be persistent and broad. So when basically all that's really happened, folks, this whole big market rally today is because the Fed said, first of all, they took the certainty out. Some people were saying that it may even be 1.1%, a whole percentage point in November, not 0.75. So they knew it was going to be at least 7.5, but they took that uncertainty off the table. It's not going to be a point. It's just going to be 0.75. And oh, by the way, we're actually sort of kind of maybe discussing that we'll slow down the pace of rates in the future depending on how the data comes out. Remember, folks, the Fed is lagging, and they're always lagging, and they're behind the curve. So the big question is, are they going to cause a crash landing, or are they going to land it pretty smooth like that pilot landed in the East River, New York? I can't remember the guy, Sully.
Yeah.
Are they going to make a smooth landing, or are they going to? Is it going to crash and burn? Who knows? But the most important thing is, what does it mean for you, and how are you going to handle it as an investor? So instead of going into some of the other topics that I had, because this is really important, this could be an inflection point. Up to the last months, we've been so heavy in cash, it's been pretty easy to just relax and not, because you're not going down with the ship. Now this may be an inflection point. It may not. So I want to turn it over to Don and get right into it and talk about what he saw in the markets this morning, how he's handling it, and how are you going to get reverse course, or are you going to change your posture, and how are you going to do that? So Don, it's all you, buddy.
Lovely. See the charts. Can you put the
Yeah, there
chart
you go.
up, Zach? Okay, so as Dan mentioned, we have a 9 a.m. Eastern call every morning, and as soon as Michael got everybody on the call, the futures went from down 0.8% to flat in the blink of an eye, and that was, as Dan mentioned, the Wall Street Journal article coming out quoting anonymous sources, blah, blah, blah. But the question is, how does the reaction to that, the initial reaction is very often a head fake. You have to see what happens after that. And some of that pop was given back. We actually ended up opening down about 0.2%. And then we had a big move up. I'm showing a 5-minute chart here. We had a big move up to 37.15. Now, this 37.15 coincides with the 21-day exponential moving average on the daily chart, which is this green line. And we rejected right there and came back down. So the immediate takeaway from that is, oh, great, another move back above the 21. It's another bull trap. You can see bull traps happened each of the prior 3 days before today. They happened with this big gap up on Monday, this move up early on Tuesday. Sorry, this big gap up was on Tuesday. This fake move higher into 37.28 on Wednesday, the move up into 37.36 on Thursday, and then up into 37.15 on today, Friday. And then you see it failing back down, breaking 3,700, which you can see is kind of a battleground area here by this line that I've drawn. So the immediate takeaway from that is that was planted. They're afraid of the bond market. The market just came back down. We're back here down to 36.68. But now, as of 1 o'clock Eastern time, we've had a resurgence back up to the high. And what I like about this is we got back above a new high and we had a pullback here, and this pullback stopped around 37.02, and then we reclaimed the 21 again. This area right here where we back tested the 21-day exponential moving average around this 3708-ish area, and then we broke out above it again. And right now we're trading at 3729. So what I like about it is that we got above it, back tested, got back above it, tested it again, and held it. None of these prior days did we hold it when we came back to this 3708 to 3712 area, which has been where the 21-day exponential moving average has been over the last couple of days. You can see it flattened out right here near the top of all of these bars, and now you can see us poking above it here with the 3728. So that's a good sign if this sticks into the end of the day, which is very clearly what we want to see, or what bulls want to see. That's a good sign for the market. So fake outs in both directions, very typical of bull markets. We took a little bit of exposure off when we failed into the 21. We put some exposure back on when we recovered the 21. And as always, we always adhere to our stops, and we'll add incremental exposure as things continue to work. But last night in my video, I laid out 6 reasons why you didn't have to be super bearish, despite the fact that we couldn't get back above the 21. And all of those things that I mentioned, as of today, are kind of working. The 10-year has dropped. Let's take a look at a chart of the 10-year now. And you can see it's putting in what's called an evening star pattern. This is after a big long run up. You get to the top and you have a hard reversal. An evening star is confirmed if you're 50% back inside the candle before the reversal. That could happen today, or it could happen Monday for confirmation. But the 10-year note coming down has been beneficial for stocks. We also saw the reversal in the dollar today. Bring up a 5-minute chart of the dollar. You can see it gapped up at the beginning, and it's doing the exact opposite of what stocks have done. First, it pulled back. This corresponded with the run up in stocks. Then it came back higher, which corresponded with the initial failed breakout in stocks. And now it's come down even more severely, corresponding with the move back up in stocks. And when I say stocks, so let's talk about the S&P 500, but all the other indexes are up over 1.5% now as we speak. So weakness in the dollar and a reprieve, at least in the 10-year bond, is certainly good for bulls. This bull flag that I talked about last night, this is on a 60-minute chart on the S&P 500. This area right here, if you draw a declining tops trend line above 37.62 down to 37.36, we've just barely broken above it now. And you can see we came down to the bottom of it when we did that pullback this morning at the beginning of the day. That's a picture perfect bull flag, and we're trying to get out of it right now. You want to see another picture perfect bull flag? Look at this chart of Netflix right here. Here's the flag pole, which is the gap up. It's invisible, but it's the gap up from the earnings day. 2 days of a pullback, declining tops trend line here, and Netflix broke out above the top of this declining tops trend line. The market needs big liquid stocks like Netflix to lead it. It needs a handful of them to push growth stocks higher and to push the market higher. Netflix has been beaten down for quite a while, but this is exactly the type of stock that can lead the market higher. And then we've got big earnings reports next week from Google, Microsoft, Apple, and Amazon. And the fact that Netflix had good growth portends well for Amazon from their Prime Video. And also, I've read a couple of articles about record signups for Amazon Prime so that people could stream this Thursday night football package. In prior years, you could get Thursday night either streamed on Amazon or you could watch it on the NFL Network. The NFL Network isn't showing it this year. You have to have Amazon Prime in order to get that. And they crashed some servers on the first Thursday night of football when people realized they had to sign up for Amazon Prime in order to be able to watch Thursday night football. So that might portend well for Amazon, and really we'll just see what happens. As always, we never predict anything here, but this all was kicked off on the 13th with that bad CPI report where we had a major positive reversal to the upside. And we haven't broken the lows since then, putting in this flag. Now the laggard is the NASDAQ 100 because that's where the weakness has been in the big tech stocks. If this can get above this declining 21-day moving average, which also corresponds to the top of this bull flag for it, that could lead the market higher. But those four earnings reports next week and those big four tech stocks are going to be going to have a lot to say with what the market does, mainly because of how heavy their weighting is in the NASDAQ 100 and the S&P 500. So we bought Netflix on that break above the 200-day moving average this morning. So let's show that one more time. You can see the black line, the 200-day, which was Netflix stopped going up the prior 2 days. I talked about how I wanted to see in the video last night about how I'd love to see Netflix do a Chipotle, which the first day up, Chipotle paused at the 200. The second day up, it broke through it, and then it kept going higher. Hey, if Netflix wants to do what Chipotle did here, we've got a position now, so that'll be quite all right with me. Notice when Chipotle did that the market was going higher, so it had the wind at its back. Right now, we're in a downtrend in the overall market, trying to get above this green line to at least start a short-term uptrend. Let's see, there was something else I wanted to. Oh yeah, we added to what I consider to be the number one can slim stock in this market. That's AEHR. They do test systems for silicon carbide semiconductor companies. Up on 44% average volume today, up 7%. Now remember, this is a thin stock, so we have to be careful with our position sizing in it because if we have to sell, we can't impact the price of the stock. But 3 days up, on the third day, it had a negative reversal. Big positive reversal today, up 7% with volume that above the breakout level too. So if we see stocks starting to break out and continue higher, this is something that has been very absent from the market over the last couple of months. Any follow through on stocks that try to poke their head out. And if we can get that going for us, as Bill Murray said in Caddyshack, which is nice, if we could get that going for us, which is nice. Gunga Gunga. So that's my.
I want to
Go
add
ahead.
one question. I want to add one question before you go. So you're talking about the big four tech stocks doing earnings next week. We've increased our exposure today, and we have, how are you going to go play it heading into those earnings?
Well, I won't take any positions in those individual stocks.
Right.
And we won't take a position in the NASDAQ 100 because of how the big weights impact that. But I won't hesitate to add to other stocks that are leading or to the S&P 500 index position that we have via UPRO right now.
Which is three
and then we'll
times
just,
the
as
S&P
always,
long, yeah.
Yeah, as always, we just keep our stops in place. Those will, I mean, a negative reaction on one of those will impact either XLC, XLK, or XLY, which have varying percentages within the S&P 500, but a much bigger percentage impact to the NASDAQ 100. So we won't.
Right. Those were tech and
we won't take a position in that.
Yeah, the
Right.
XLP, the ones that he was talking about, folks, are technology or
CK
growth
and
sector.
Y.
Yeah, ETFs. Okay, so now so it would be a very positive for the market if at least three of those four companies reported pretty strong. And when I say strong, folks, it's all relative because they'll sandbag the analyst going into earnings so they can always, quote, beat the number. And it's really not the number itself. It's how Wall Street perceives the number. Are they beating the whisper number? It's all cryptic. It's so funny. But if that happens, then you'd be ready to add in the NASDAQ?
Yeah. And one other thing, show the charts again, Zach. Very important. This is the VIX. This was one of the 6 things that I mentioned, a reason to not be bearish. I'll follow through to the downside on the VIX today, breaking below 30 and below the 21-day exponential moving average, and the slope of the 21 has now rolled over. If this can get down, the sweet spot is this 24 to 26 area. There's going to be a lot of battle in there. If the VIX gets below 24, the market is going to go higher. I usually don't make definitive statements, but it's depending on whether or not what the VIX does. But if the VIX breaks below 24, and every tick down with the VIX, the market should go higher. They have been almost perfectly inversely correlated over the last, or really throughout the year, but especially since June. You can see this perfect cup and handle. You've got an inverse cup and handle on the S&P 500, inverse cup and handle on the S&P 500, and a cup and handle in the VIX. So they usually are inversely coordinated, and they certainly have been lately.
But you got to keep a very close eye on it, folks, because the VIX is a concurrent indicator. It happens it happens in real time with stocks. So it doesn't really help looking. You got to really be paying attention and be Johnny on the spot using the VIX.
Yeah, the VIX, the dollar, the 10-year, and the market are all very correlated, inversely correlated right now. So it's hard to say which one's leading which, but the market is certainly reacting to the dollar, the 10-year, and the VIX.
Okay, all right. Well, listen, folks, I'm gonna let Michael and Ted see if they want to add any comments to that, and then we're gonna get to Michael's revisit of a sector that he really thinks has a lot of potential. Mike, did you want to add any comments to this?
No, I was just wondering. So MarketSmith hasn't updated yet, but from what I can see, are we potentially tracking for a follow through day today on the S&P?
Yeah. So I checked SPY and I actually tweeted it out. We are around 1.7% up on the day, and we're tracking at about 50% above average volume. So as of now, you would get a follow through day.
You can't go by the SPY volume. You have to go by the index volume that's shown on the MarketSmith homepage. And NYSE volume right now is up 11%. By the end of the day, first of all, the volume's going to get blown out of the water by the end of the day. It's absolutely going to be higher because today is OPEX. Options expiration. At the end of the day, there will be a ton of trading. So you'll get the volume. The question is, will you get the percentage move up on the indexes?
Which needs to be what?
1.4 to 1.7, depending on the index.
Okay.
Yeah.
Okay. By the way, that stock you were talking about that was your number one Can Slim stock, I believe, if I'm not mistaken. I think it's also the number one stock. IBD is also saying that it's the number one. So I think it's on their number one list too.
Well, obviously they listen to our videos.
Clearly fans.
Hey, a few times they've come out with some things right after. Anyway, we mentioned them. All right. Michael, let's go. Go ahead. Ted?
I'd also note that there's a character change on the dollar. So if you go to UUP, in the last 4 weeks, I think today's the 5th distribution day. And so that's something to note. And since the dollar and equities are inversely correlated, that is good signs for the bulls.
Okay, let me put my Ted Terpreter on for the people that haven't been following the podcast very long. So the dollar's been very strong lately, and when the dollar gets strong, the market gets weak, and vice versa. So strong dollar, weak stocks, weak dollar, strong stocks. He's saying that it looks like the dollar is peaking and rolling over and getting weaker and may be headed down, which is also bullish for stocks. So there's a couple, and that fundamentally that makes sense, because if the Fed says we're going to be a little more dovish, they're not protecting the dollar. The dollar is going to come down in price. One of the reasons the dollar has been so strong is the Fed has been so hawkish and strengthening, raising interest rates, which is actually very strong for the dollar. Okay. All right, Michael, let's go to your favorite, one of your favorite sectors. You talked about it a few weeks ago, but now we're talking about it again, nat gas.
Yeah, actually, you're right. It is my favorite sector. Big fan, been following it for a while. So I wanted to revisit it because it's still doing well. So I will revisit some topics from now and then, as long as they're doing well. And the ones that aren't, maybe we'll forget about those. So going forward, I'm just kidding, by the way. We'll revisit all of them. But it is nice that that natural gas has been working. So we'll start with that one. So fundamentals, story's still the same. European natural gas, the way they track it is Dutch TTF. Prices peaked 2 months ago, and now they're back down, but they've settled, and they are continuing to settle at a level that is 6 times higher than where it was last year. So now it's at $36.77 per contract, and this time last year it was at $5.50. So it's settling well above the levels that it got to. Was like over $100 per MMBTU was totally unsustainable, and the market wasn't even really pricing that in because it couldn't remain that elevated. But where we are settling is still extremely supportive for the U.S. producers and exporters to export and sell it in the European markets for an insane premium. Um, just for comparison, prices in the US are now at $5 per MMBTU. So 7 times more in Europe if you're selling abroad. So now this chart, LNG, which is my favorite stock in the entire market right now, in terms of story and fundamentals and technicals. So when we bought it originally, August 10th, on that breakout above 150, you can see the basically that entire consolidation it had from April to August. It went sideways while the market was coming down, and it was building relative strength, gaining, and then the relative strength broke out before price did. We came down a little bit, flagged, and then the stock broke out. And when it broke out on August 10th, that's where we took a position. Since then, where the price is today, LNG is up 16% from that breakout point, and during the same period, the S&P 500 is down 12%. So it continues to build momentum and strength, perform super well, and it's now consolidating near its highs and could potentially be setting up for another leg higher. A lot of analysts and people that are covering the stock now have price targets over $200. It's now pretty watched and covered in the market, so there's still a lot of room for it to go higher. I like about the chart as well is that it has had shakeouts along the way. So when it first broke out, hit that high of around 173, came down to 150, tried to break out, couldn't, and came back down. It actually undercut its 50-day moving average, hung out there for 2 days, and then gapped above. And that was a big shakeout along with the market. Got rid of, I would say, weaker hands, and now it's setting up and continuing to move higher. And basically, after that shakeout, you can see it was there were, I think it's 10 days, 10 consecutive days of just buying, 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 while the market was kind of hitting lows. So a lot of accumulation and power there. The story, the fundamentals are still extremely supportive. So I'm holding a position in it. I've had a position. I actually added to it on weakness, just because I have so much conviction in it, and no reason to sell yet. And I would look to adding more on a breakout of these highs, if the market's supportive. But I've already got a pretty large position, and don't want to overexpose myself. But yeah, it's still looking good. So I like that a lot. And something I wanted to mention, that I didn't cover, I don't think very well in the when I did the segment a couple months ago, was the difference, so that people understand the three sort of um, groups within oil and gas, and you've got upstream, downstream, and midstream. And LNG Cheniere is more of a midstream play within that industry. So what the difference is that upstream is basically the explorers. The upstream, they're the ones who actually identify deposits, drill for wells, recover new materials underground. So that's your exploration and production. Downstream is what occurs after the production phase to the point of sale. So anything that has to do with post-production of oil and natural gas. So for example, refining and delivering those products directly to consumers is the downstream. And then the midstream is involved in the storage, processing, and transportation of the products. So what Cheniere does, the reason why they're doing so well, and they're kind of unaffected by fluctuations in prices, is because they actually purchase natural gas from the American producers. So they don't produce it themselves. They process that gas into LNG, and then they offer their customers the ability to load that liquefied natural gas onto their own vessels directly at that plant in Sabine Pass in the Gulf, or they actually have their own ships as well. They call them trains, where they can ship that LNG to regasification terminals around the world. So their business is less susceptible to fluctuations and volatility in the actual commodity price themselves. Um, so that's your midstream play, and there are some other midstream plays within that sector that are working well. One of them is STNG. It's a little small for us, so it's kind of hard for us to get in, and we have to pick between less liquid names over at Revere. But this is a stock that's doing great as well, and they're involved in they have ships where they actually ship the product, so similar to LNG's shipping business. And then another one that came up on my radar recently that's actually breaking out and looks really good is DCP, and that's a pure midstream play. They do a lot of the marketing and sales and securing contracts for these LNG companies and gas and oil companies. If you look like on a weekly chart and a monthly chart, you can see it's getting up to that level. It's got the volume, it's got good characteristics and fundamentals, and it could continue to break out. But it's also a little on the thinner side, so hard for us to own at Revere. But that sector is continuing to do really well, and it's got the momentum and the spotlight behind it. So I guess now it's just looking for exhaustion and looking for reversals in either the fundamentals or a breakdown in the technicals to determine that the trend's over. But could be early stages of the trend here. So we shall see.
That's exactly right. And I was going to make that comment. I was going to say they're actually like the railroad cars for natural gas. They just like the rail is the distribution for the United States for products. And what he means by not being affected by price so much. So the upstream, the producers, they get huge fluctuations with the price because when the price goes way up, their stock pops and they're much, much more profitable. When the price goes down, they got to start capping wells and it's not even profitable to do business. With the midstream, they're just the middleman. They're just paying for transportation.
Right.
So price goes up, people kind of cut back a little bit. They may do less volume, but they still it's a higher price. If the price comes down, people use more. There's more volume, but a lower price. So it's a lot more stable and they don't have to worry about that. All right,
and sorry, just one, yeah, go ahead.
You go first, Michael.
I was just going to say, tagging along to that. So what, and then the reason why LNG, Cheniere specifically, and when I say LNG, I'm talking about Cheniere. That's their ticker. The reason why they're so special in this midstream business is because not only do they market and sell transport the natural gas, but they are the largest premier liquefier of that natural gas. So and what they do as well is their contracts are long-term contracts. So 85% of their business, their cash flows are already stable and secured for the net until 2050. So they've got long-term contracts, very visible. And then the 15% that isn't secured yet, they're able to take advantage of opportunities in the market when they come. So that 15% now, they're taking advantage of this opportunity in Europe and selling that LNG to Europe. So they've got the stable, steady income for decades, and then they've got the 15% flexible where they can really take advantage of these arbitrage opportunities.
Arbitrage opportunities.
I thought it was really.
Go ahead.
I thought it was really nice of them to put midstream in the name so that if you had any question as to whether or not they were upstream, downstream, or midstream, it removes any question that you might have.
Yeah. Look at that.
Dan, I have a question for you.
Go for
Dan,
it. Yeah.
We know that you are a large producer of natural gas, so maybe you would know this.
Go ahead, Don.
Dan, this is a limited partnership. Do all LPs produce a K1 for tax purposes?
Yeah, I believe so. I'm not aware of a limited partnership that doesn't do a K1. And if you're an LLC taxed as a limited partner, is a partnership, I think you do a K1. Partnerships, by definition, do K1s.
Okay, so come tax time, just a note to anybody listening. This is a beautiful chart. You can see massive inverse head and shoulders. Breaking up, if it breaks above that neckline, it's a very clear breakout. The fact that it is an LP, you could get an extra document at tax time, and people that own this in IRAs will get that document also, and they may be responsible, correct me if I'm wrong, for having to pay or take a gain depending on how the limited partnership paid out its profits or losses. Is that correct?
Well, so let's back up, because I take a little bit of umbrage with investors getting so scared of getting K1s. I get it; it's kind of a hassle, but the reason you get a K1 is you can actually pass on depreciation and other items so that you shelter some of that dividend. So on a partnership, it could be considered return of capital first and dividends second, or interest second. So you could actually have a lot of that, so it reduces your cost basis. So it actually is kind of gets preferential tax treatment for a long time, for years, if you're willing to deal with a little bit of a headache. Now, with regard to the IRAs, when they have unrelated business income, UBI, okay? So if they're a natural gas producer and all of a sudden they take a left turn and decide to sell widgets or deliver meal, do something totally outside of natural gas, that's unrelated business. And if you create income out of that, it used to be $1,000, it may be different now, but if you had over $1,000 of unrelated business income, then that can be taxable. But their normal income is generally not taxable, even in IRAs. Don, my CPA says, don't even worry about it. I've never seen the IRS, do anything, because hardly any LPs do unrelated UBI. So,
okay.
So anyway, all right. By the way, I love these two sectors, nat gas and coal, both. Michael found those. Basically, that is the sector those two sectors run this new Green New Deal. Mm. I mean, those are the sectors that power electric cars.
Yeah, it's a real good
bet. That is the great. It's not electricity. Electricity doesn't happen out of thin air. You've got to create electricity by burning coal, burning nat gas, using big turbines at a water, dam on a river, yes. Or you do nuclear.
Electric generation.
When you can generate, you can run your toy car.
Uh-huh.
Anyway, all right, I digress. All right, now, for this next topic, we're actually going to bring on Ted, because he loves, Don does too, some, and I think Michael does as well, but stage analysis, and it was stage analysis by Weinstein, and he's very good. And so take it away, Ted. Let's see what you got.
Yeah, so on this podcast, we always throw around stage 1, stage 2, stage 3, stage 4. And for those of you guys who may not know, that is a concept just developed by Stan Weinstein. He wrote the book Secrets in Profiting in Bull and Bear Markets. And I think it's just a foundational, technical analysis concept that everyone needs to learn first, because it helps you identify the longer term trend. So volatility contraction patterns, cup and handles, don't matter if you don't get the long-term trend correctly. And so, Don, can you pull up the PowerPoint if you don't mind?
It's up there.
And I could just go
Got it. There it is.
Oh, it is? Oh,
There
perfect.
we go.
So, stage analysis in Revere, I'm sure it's part of Don's process to look through charts and identify which stage we are in. And since we're a trend following firm, we want to put all the probabilities in our favor when we take either a long position or a short position. So this past summer, actually, why I'm so interested in this concept, I interned at Trader Lion, and I was lucky enough to help Stan Weinstein and the team create his masterclass, which is on their service, and I actually highly recommend it. And stage analysis during this bear market has helped me personally, and Revere as well, stay on the right side of the markets. And so let's get into it. So what is stage analysis? So Stan Weinstein identify repeatable trends in stocks, in almost any securities, futures, even commodities. And he developed this concept, and he separated it into 4 stages: stage 1, stage 2, stage 3, stage 4. And the main thing is to watch the 30-week moving average and the slope of it. And what this does is enables a trader or investor to put the trends and probabilities in our favor when we want to take a position. So let's get into stage one now. So stage one is the basing area, and this occurs either after a stage 4 decline or after an IPO. The bases are a little different because you won't have the past, like the previous price action after the IPO, but the concept is pretty much the same. And this is when supply and demand moves into equilibrium. Buyers and sellers are pretty much balanced, so you'll have ups and downs, failed breakouts, failed breakdowns, but overall you're still within the trading range. And during this time, we're looking at the 30-week moving average to catch up to the price, and it's also flattening out at the same time. So the stage one area is the neglect phase because it can last weeks, months, or even years, and you don't want to sit in a stock that is not doing anything. So now we will move on to stage two, and this is where you want to be taking your long positions because in the 30-week moving average has began an uptrend. We've broken out of the previous trading range while we were in stage two, and this is where we see like price and volume characteristics of volume moving higher as the price moves higher and dries up on pullbacks. And so I'm tying in a study done by Minervini actually, like with computer models, and he found that 99% of biggest winning stocks actually began their moves in a stage two uptrend. So why would you buy something in stage one, stage three, or even a stage four when you're in that 1% club? And that, like, why would you ever want to be in the 1% club? The probabilities just aren't in your favor. So on to the next slide. I have an example of a stage two breakout in Square from 2016 to 2018, that time frame. And you see that the volume comes in on that breakout above that trading range down below. And then on the right, we have Coupang, and it just kind of shows and illustrates the characteristics of a stage two uptrend. When we move up in price, the volume comes in, and once we pull back, it's very tight and subtle, and the volume dries up. And so after stage two uptrend, stocks don't go on forever, and now we enter the stage three topping phase, and this is where we have to start being careful, lightening up on our positions, maybe even completely selling out of positions, because stocks run out of steam and often they'll fall off cliffs. So the first sign of a stage three is when price slices through the 10-week moving average on volume. Whenever that happens, that's the first red flag, and we must just start being aware of and keeping track of the price and volume action and being aware to see if we want to reduce or sell the stock. And this is where the 30-week moving average flattens. We get wider, looser, and more erratic price action. And we'll also get churning, which is either we see high volume, but it doesn't go either up or down, and it just kind of stays within a range on high volume. And a final characteristic of stage three is that there's good news coming out about the stock or commodity, but we can't make new highs. And then so on the next slide, I have an example of Amazon, like the recent example of its top. And you can see how erratic the price action is. You can see the 30-week moving average flattening. And yeah, that's pretty much stage three. And one of my favorite quotes from Weinstein is the bigger the top, the bigger the drop. So Amazon is not doing quite well this year, and you can see why. So finally, this is the stage four declining phase, and this is where you want to sell all your stock. You do not buy here or average down because it can lead to detrimental losses to your portfolio. This is where you can do some judicial shorting, even though shorting is definitely like more difficult than buying the stock. And here's another Minervini concept. Minervini and Stan Weinstein are like really good friends in real life, so I have to kind of tie their concepts in together. And Minervini has a concept called the 50-80 rule. So that's when leading stocks top, 50% of them go down 80%, and 80% of them go down 50%. And this market definitely has reflected that all around. And so we enter stage four when we break down below the 30-week moving average, declining 30-week moving average. And the characteristics of the stage is lower highs and lower lows, while rallies are on lighter volume. And so in conclusion,
that looks a lot like 2022, doesn't it, Ted?
Oh yeah. And that's like this simple concept, in my opinion, has revolutionized how I see the markets as a whole, like whether it's an index, commodities, or individual stocks. And so finally, in conclusion, just to summarize a few like major points, we want to buy in stage 2 uptrends because we want to be in the 99% club, and we want to sell stocks in stage 4. This concept, stage analysis, keeps us objective because we put price action first and not our own opinions. And then finally, since I kind of took some like screenshots out of TraderLine's masterclass, I highly recommend going check out that class. Got to give credit to them. And yeah. And so Don, actually, I wanted to show a few stocks from the last cycle that kind of like perfectly embodies this concept. And then I wanted to show one more stock that is just rolled into stage 4 from a stage 3 top. So the first one is ARK K, the notorious ARK, Kathy Wood ETF. if you go on the weekly and then compare it to that first graphic
this
in
touches
my
all the
presentation,
stages, doesn't it,
you
Ted?
can see it. Yeah.
Man.
You see stage 1, stage 2, 3, and 4. And like if you're just buying stage 2, just follow the 30-week moving average and just some simple price and volume action analysis. You'll catch the move in, like you'll catch the major uptrend and get out of the way before we see like what 90% decline, 85, 90% decline.
That
So
50,
the second
80 stat, I love that.
Yeah.
Yep.
Yeah, I know. And so the second stock I want to look at is DocuSign. And if you go on the weekly, it depicts stage analysis quite well. You can clearly see the stage 1 basing phase when it IPO'd, then it started that stage 2 uptrend. That's that stage 3 top, which was from like that late 2020 area to late 2021, and then that massive bar down. I think that's probably on earnings or something below the 30-week moving average, and ever since it's been in a decline. And if you were to buy and average down, you'd be losing a lot of money.
That's exactly what I was going to say. How many people said, "Wow, what a great deal after this big earnings"?
Yeah.
This was a $300 stock. I can get it at $150 now.
Mm-hmm.
It's trading at $7.
Mm-hmm.
Well, it's like it's the COVID
Now,
stock, like Peloton. I mean, the story was over.
Yeah. And then now let's go to a bigger company or a larger cap that people thought could never go down this much. Let's look at Netflix, which was part of like the FANG acronym. And you can see the characteristics of stage analysis as well. And we're actually coming back.
This is looking a little stage 1-ish here, isn't it, Ted?
Yeah, exactly. Stage 1-ish.
Yep.
And so I didn't get into like a more advanced part of Stan Weinstein's concept, but he like separates each stage into like minuses and pluses. And so I would characterize this as a stage 4B minus, which is we're about to enter stage 1, and traders can get more involved in these areas, like how Revere has just gotten involved, and we can get some nice little profits down here. And then
that's
finally,
good because during your presentation, Michael and I added to Netflix. We've got a 6% position now. See how we can multitask here?
Nice.
Yep.
And then the final stock I want to look at, it hasn't completed stage 4, but it's seeming like it's going to happen, is Tesla. And currently people still don't really see Tesla going down that much more, but we'll see if the Minervini 50/80 rule continues to hold up. You see that huge top. It's almost a 2-year top now. So like Stan Weinstein said, the bigger the top, the bigger the drop. The 30-week moving average has rolled over, and we are making lower highs and now lower lows. And we also have a head and shoulders breakdown. So not looking too good for Tesla.
All right, Ted. Well, listen,
that's my presentation.
That's awesome. So, folks, in just a kind of a big macro view, now they dig deep into the specifics, the technicals, the numbers, the statistics. It's very calculated. It still just gives you probabilities. It's still not an absolute. But basically, in a nutshell, what he's saying is you don't want to try to bottom fish and buy. They're talking about a whole cycle from the beginning of a big rally off the bottom all the way up to the top to the market peaking and then the stock sell-off. It's one whole cycle of a stock. So stage 1 means that you're bottom fishing. You don't know yet. It hasn't been confirmed that it's going to, rally strong, right? And that's why he's saying, Weinstein's saying, you don't want to buy stage 1 because it could be 2 weeks, could be 2 months, could be 2 years before everybody recognizes, hey, this stock may be good. Once you start getting into stage 2, people are starting to accumulate, starting to buy, and it's about to run up. And that's really the bread and butter, the filet mignon of the move, if you will, right in the middle of it. Then stage 3, it's forming a topping pattern, and it gets choppier where you still have high volume, but it's just sideways. It does not doing anything. And finally, you have the whole sell-off, the big collapse. And, even IBD, that 50-80 rule from Interveni's grade, even IBD will tell you from their studies that leading stocks drop on average 72% from their top.
Wow.
Let me repeat that. Leading stocks drop 72% from their top. That means some stocks drop 90% or more, Peloton. Some stocks may only drop 45 or 50%. To get that average, okay, but basically what that's saying is the best, and normally those are the best of the best, the ones that ran up the most. And that's why it's so important to keep that in mind and not just buy. If you just buy and hold, Don, pull up one of those charts, please, with a stock with that cycle. If you just buy and hold, this is a great point. So pull up not Tesla, the one before, that went all the way up, then all the way back down, right? So if you have a buy and hold mentality where you just sit there, you ride it all the way back up, and then you give it all back down, and just like that. And that's why there's that study called Sequence of Returns that said if you just do a buy and hold pie chart, your quality of retirement is simply a function of when you retire, what the market is doing the 3 years in and at retirement. So if you retire right there at the top, your retirement's twice. They're assuming you're just going to go to cash and never do anything again, right? Which is also not quite true. But the whole point is, if you retire at the bottom, like after the tech wreck or after the economic crisis, you have a lot less money. And so we think there's a better way. We think it's quantifiable and measurable. Does it make you be much more active? Yeah, you're trading more, but you also have a lot less drawdowns. So it's a lot. And by the way, the mutual funds do trade behind the scenes. It's like the Wizard of Oz. You just can't see behind the curtain. They won't show it to you. That's one of the reasons they like these mutual funds, because you can't see all the activity. Now, but the other thing is, most mutual funds have to be fully invested 90, 95% at all times. So if they're a tech stock, they got to be all in tech regardless. So you're not the client. The fund is the client. The money manager is managing to the prospectus of the fund. So when he gets money in, he invests it, even if he thinks tech stocks are way too high. So it's your job to know when to sell the fund. People don't realize that. They think the mutual fund kind of represents them. No, it's just a tool. You want to be in that sector at that time. If you don't, you shouldn't own that fund. There are no breaks in most mutual funds. They can't move to cash. They can't get defensive. There are a few exceptions, but they're far in between. All right, Don, you want to quickly talk about what you're going to be looking for heading into next week? You covered quite a bit.
Whether or not we can hold this 21-day moving average is the key for the close today and going into next week. This is exactly what we want to see. We've had a couple of false moves here. This reminds me of this area over here where we tried to break down but just could not get below the lows of the shakeout area. This ends up being an island bottom. This was an island bottom, and see if we can set our sights on the declining 50-day moving average.
All right. Well, folks, listen, the Fed came out and made some surprising changes to the sentiment, their kind of view coming out. They talked a little more dovish, and that really kind of ignited the markets. And this was we had a few other things to talk about. They are in the show notes, and maybe I'll hit them next week. But if you want to talk about any of those, look, the economy is still in jeopardy. And we're still we're actually in a recession now, regardless of what the politicians say. But it's a very mild recession thus far, but it looks like it's going to get much worse. China's in deep kimchi. Here's the thing. You've got to separate Main Street.
What is kimchi?
Kimchi. Deep kimchi. You never heard that? Kimchi.
I don't know if I've ever heard anybody say it like they're in deep.
I don't know. That's just, I guess I inherited it from my dad. My dad used to always say, you're in deep kimchi.
Yeah, sure.
I don't know what that meant. Anyway. So now I lost my train of thought, Don. Thanks.
Yeah.
So the point is, you don't want to just do it, just be in there random. You want to take action. But the reason we switch gears today and we didn't go over some of those topics is because we've had a few false starts and sputters in the past 2 months where we've gotten in a little bit and gotten out. This actually hit resistance and banged up against it a couple times and then broke through it. This might be a little more sustainable. And we're not making predictions. I'm not saying it is, but I am saying the Fed has made a key shift in posture. At least they jawboned about it. Now, whether that's just political, so the market doesn't just go totally in the toilet right before the elections, or whether they really do mean it and they want to, well, they're not supposed to be political. They're supposed to be apolitical, but let's face it, they're not. Or are they really going to change posture? Remember, the market will rally, and it'll rally strong. You'll be in a bull market before you come out of a recession. Just like the market will sell off and go into a bear market before the recession, which has happened this year. So the market is a leading indicator. The technicals lead the fundamentals, folks. So before you see earnings getting better and better, the stock price is already going to be up. Because some of the best minds in the world have figured that out. So these big multi-billion-dollar funds are doing, now whether they're right or not, sometimes they'll make a wrong turn and do the wrong thing. But that's still where the money is going and prices are going up. That's why we always say at Revere, price is truth, and you don't argue with price. Okay? That's just the facts. And so we want the fundamentals to correspond and dovetail with the technicals, but when it's time to sell, the technicals always trump everything. And by the way, we will also buy some on the technicals off the bottom with a tight leash, knowing that we could get stopped out if it didn't work out. Because when it does come off the bottom, you'll get a 15-20% pop in a very short order. Just like when the market sold off, they lost 20% in a month. And if you just sat there and didn't take any action, you were down 20%. So anyway, folks, listen, if you like what you heard, tell a friend, tell a neighbor, just send them to revereasset.com. Up in the upper right-hand corner, there's a subscribe button. They can hit subscribe, just put in their name and email address. We won't spam them or reach out to them in any way. It's up to them to reach out to us for a complimentary portfolio review, or just if they want to learn more about Revere or have questions on a stock or their own portfolio. Our daily market insight video that we do, a short 10, 15-minute video every night. The markets are open. We send out in the evening. It's free. It's like drinking from a fire hose. It's very red meat. That keeps you abreast of what we're thinking. We talk about what we're actually doing in the shop, buys and sells we make. I mean, we are one of the most transparent advisor that I'm aware of. And then also they'll get this podcast delivered in their inbox every Saturday morning once it goes out. But if they sign up for our YouTube channel, if they go to Revere, just Revere Asset,
subscribe
and
on
click
YouTube.
subscribe, once Zach posts this in just an hour or two, you'll actually get it Friday afternoon after it's sent out.
You'll have it before 2 p.m.
The market is still open when you get this.
That's right.
So if you want it quicker, you can actually get it quicker. And you can always email any of us, Dan at revereasset.com, Don, Michael, or Ted at revereasset.com. And you can also always call us old school at 855 Real Wealth, and Meryl will get you to the right person. Have a fun and safe weekend, folks, and we'll talk to you next week on Your Money.
Because it's not how much you make, it's how much you can keep.